So this is your constant income capitalization method, and the constant income capitalization method has a variation. And what is the variation? Variation is multi-period constant growth income method, and that means what? This is also known as Gordon growth model, GGM. This is also known as Gordon growth model. Now, what is the difference between the model that we discussed in the previous slide and the model that we are discussing in this slide? And please remember, it's very simple. In the previous slide, we assumed that the income is fixed and is going to be fixed for all the times to come. So that was the constant income. Now, what we are discussing now is that this is constant growth in income. So that means you calculated the average income based on the past numbers.
Yes, sir.
Now you are assuming that this income is going to increase by a certain percentage. So you will be finding out value of the business based on the growth in that income, and that is why it is known as constant growth in income method. And this is also known as Gordon growth model, GGM, Gordon growth model. So you can see here D1 upon KE minus G. What is D1? D1 is income in the next year. That is the D1. D0 is income of this year. D1 is the income of the next year. D2 is income of the second year. D3 is the income of third year. So this is how it is exactly. So you have D1 divided by cost of capital minus G. G is the growth rate. G is the growth rate. So that means if my income is going to grow at a particular growth rate, that means effectively my return expectation can be lower. And why my return expectation can be lower? Because of the growth, I am getting that additional growth in any case. So I can be happy with the lower cost of capital. And that is how you can see here KE, cost of capital, minus G. G is equal to growth rate. So
That is why we are minusing, sir. That is why the KE minus G.
That is why the KE minus G. Minus G, see, when you minus G in the bottom, in the numerator, by default it also means that you are adding G in the numerator. Are you with me?
Yes, sir. Yes, sir. Yes, sir. Yes,
Right.
sir. Yes, sir.
So just to give the effect of growth in your valuation, so you minus the G, and you can see it, Sukumar, very easily. If you minus the G, the valuation is going to be higher. If you don't minus the G, valuation is going to be lower, right? So by minusing G, you are incorporating effect of the growth in your valuation, and this is what we will check also together.
Sir, but the reason you are telling now, sir, that I am ready, because of the growth, I am ready to reduce my expected return.
Correct.
That is very logically I am understanding, sir.
Absolutely.
So long time I am having doubts, sir. Now it is logically understood, sir.
Good.
Because I am expecting a growth for every year.
Yeah.
So I am ready to have less return also.
Absolutely. Because I'm getting compensated in any case because of the growth.
Yes,
So
sir, definitely, sir.
absolutely okay.
But
And-
the numerator D1, why D1, sir? Why next year? Why not D0?
Yeah, see, it can be D0 also, but D0 would mean that you are assuming that your income is going to be constant.
Okay, sir. Okay.
So
Okay,
in the
okay, sir.
previous slide, you would remember we said D0 upon cost of capital, because
Yes, sir.
in the previous slide we assumed that there is no growth, and now we are assuming there is a constant growth, and that is by G.
Fine, sir.
That is by G. Okay. So let's do another case on this.
Yes, sir.
Right. So this is what it is, and here is a small case study. So you can please solve it. I'm sure you will
Yes,
not
sir.
take a very long time to solve it.
Yes, sir.